Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, welcome to Better System Trader. Today's guest is a full-time trader, author, educator, and licensed futures advisor. He began his trading career in 1983 as an institutional dealer with Bank America, and today specializes in trading global currencies and index futures, actively trading 24 markets around the world. He's a popular and sought-after international speaker who has presented to traders throughout the Asia-Pacific region, including Australia, New Zealand, Malaysia, Singapore, Hong Kong, Vietnam, Thailand, India, and China. He's published a number of trading books, with his latest book being translated into 6 different languages. What really impressed me about this guest when I met him years ago is that he publishes all of his trading results on his website for all to see. These are not hypothetical trades or paper trades. They are actual trades placed in the market with real prices, which is something very few people do even today. He is a trader first and foremost. The interview today covers fundamental topics that impact traders of all levels, from beginner to advanced. We talk about some of the psychological issues traders face, the principles all traders need to accept to be successful, that elusive holy grail of trading, and an extremely important mathematical concept that can identify if you're going to blow up your account, so don't miss that one. The guest also provides actionable tips and tricks to overcome these issues, along with a simple method to determine if a strategy is broken, which could save you loads of money and stress. Anyway, enough of the intro, let's get stuck into it. Don't forget to continue listening after the interview is finished to find out more about the session bonus, my top 5 tips from this episode, and a sneak peek at the next episode. So let's get to it. The guest for today is Brent Penfold. I hope you enjoy it. Okay, thanks for joining us today, Brent.
Oh, you're welcome. Thank you for having me.
First, let's start with how you got into trading.
Oh, it was a long time ago, probably 1983. I was basically at university, and I was at the end of my 3rd year and looking for something to do over the Christmas holidays. And I was talking to a gentleman who I suppose I was introduced to through my father, who Dad had great respect for, and I had a chat to him, and he said, you can always employ people to operate factories, but he said the great mystery is money and how it moves around. And Tony suggested that I should look to get some work experience in finance and the money market. So I just wrote off to all these merchant banks, saying I was doing an honours in finance, and I'd like to get some summer work experience over the holidays. And I had quite a few interviews, and Bank America kindly offered me an opportunity on the condition that if they were happy with my 3 months of contribution over the Christmas holidays, and that I passed my honours year, that they'd have basically a call option on my employment after I graduated. And I thought that was great. So I worked for them for 3 months, and they put me into the money market department, onto the money market desk. And I was meant to rotate through to the banking department. I think I had 4 weeks in money market. I think I had about 2 or 3 days in banking, and they put me back into the money market desk. And this all happened at a time when Paul Keating was introducing foreign banking licenses into Australia. So all the foreign banks wanted to establish themselves in Australia, and I was just very lucky that at that particular time, Bank America wanted to receive a full banking license, and they wanted to beef up their treasury department and their dealing desks, and they offered me full-time employment on the bank bill desk back in December or early January 1984, and I accepted. And like any young person, you can be easily impressed with your first experiences, and I was, and it was at a time in Australia when everyone was thinking that Australia would float its currency, because at that time the currency was fixed. And I was on the money market desk, back in those days, the promissory notes, short-term CDs, bank bills, shared the same desk as the overnight cash and 24-hour cash people. And I just saw firsthand this flood of money just coming in, buying Australian dollars and just parking money short term. And we couldn't buy enough promissory note CDs and selling it to these investors. And in a week, I saw our desk make over $1 million. And from that moment, I was hooked. So that's how I got started.
So fast forward to now, what type of trading do you do now?
Well, now, essentially, I'm what they call a mechanical trader or a systematic trader. I never was when I was at Bank of America. I was like probably most people. I started off as a discretionary trader and trying to understand, I suppose, the bigger picture, where all the fundamental pieces of the global jigsaw would fit together. But I didn't have any success as being a discretionary trader. So I learned to become more methodical in how I would identify setups and trade. And so today, really since the late 90s, I've been a 100% mechanical trader. I suppose over the years have evolved and spread, I suppose, the portfolio of markets that I trade. I suppose when I started to go public with my stuff, at that time I was a specialist index trader and primarily index futures. So I would trade the Australian SPY contract, but I traded Asia. So I did trade, and I still trade today. The Nikkei, the Taiwanese, and the Hang Seng index. Across to Europe, I trade the FTSE index, the DAX, and the Stock 50. And then moving across over to North America, I trade the mini NASDAQ and the E-mini S&P. In addition to that, I trade the 5 main currency pairs, Forex, the Euro, Pounds, Yen, Swiss, and Aussie against the US dollar. And I also now trade a diversified portfolio of markets, which also not only include indices and currencies, but I trade the commodities, the softs, the grains, I trade the meats, trade the metals. So essentially today, I basically trade, about 24 markets actively.
Wow, that's impressive. When do you get time to sleep?
Well, that's one of the benefits of being a mechanical trader, that if you look at what I do each day, I'm the most busiest, essentially is just collecting the data, the end of day data for all of those markets. And because I'm placed in Australia, like yourself, we are so lucky because essentially when the main market finishes, which is North America, when they're going to bed, we're waking up. So, all those, markets have essentially completed the previous 24-hour cycle. So in the morning, I'm just flat out finishing off collecting the Asian data, end of day, the open, high, low, close, and volume. And I go through to collect the European and the US markets. So I'm just really busy collecting, updating my data files with daily data. And then I press a couple of buttons because being a mechanical trader, I have everything, it's all modeled up in computer programs. And certainly the programs take a while because they're obviously opening up a lot of data files, but essentially the computer tells me what my position should be, what my stop should be, what my conditional stops, how they can be improved if the market continues to go in my way. And if there's any new setups, the models just tell me that I should be looking to buy or sell a particular market. So it may sound like I would be very busy, and I am very busy for a small, concentrated amount of time. But because I trade mechanically, I can code up my models, and because my models are essentially very simple, the results are presented quite quickly, so that I'm essentially finished by about 9 to 9:30 every morning.
Well, thanks a lot for that, Brent, explaining how you're currently trading. That's really enlightening. I'd just like to move on to your book, The Universal Principles of Successful Trading. So it has so much useful information in there for traders.
Mm-hmm.
You start the book with a chapter called Reality Check, which I found quite interesting. It explains why the majority of traders lose.
Mm-hmm.
So why do you think 90% of traders lose?
Well, I think the initial answer is because we're human. And as humans, we love to work in our own self-interests, and we love to take the line of least resistance. So we shouldn't feel guilty about being human, and therefore that's probably why we lose. And to just to explore that further, as humans, because we do work in our own self-interest, and because we unfortunately like to cut corners, I believe the reason why 90% of us lose is because we're lazy, and because we're lazy, we are ignorant, and it's simply that. And then we can peel back the layers and discover more reasons how being lazy and ignorant deliberately or conclusively leads us down that path to the poorhouse. Because anyone who hasn't got the proper knowledge can't be expected to make informed decisions. And if you're not making informed decisions, then certainly in trading, all you are doing is gambling. And we know gamblers lose. And it's no different in trading. So unfortunately, we're very trusting as human beings, which means that, some of us or most of us who do start trading and we do lose, we may think, oh, we should make an effort. And we'll go buy a few books or we'll attend a few seminars on trading. And once again, because we are human, we are very trusting. And unfortunately, we do believe what we read, we do believe what we hear, and we do believe what we see on PowerPoint presentations because we're so trusting. And that's another reason why we find it, or why we struggle to be successful during the early stage of our trading. So they're the primary reasons that we're just, we want to find the easy way. We're not prepared to put the effort in, and that means that we're basically, we don't have the right knowledge, and therefore, we take all the wrong steps. And it's not until we've taken so many steps in the wrong direction that we see our account essentially heading south to a point where we feel we can't place another trade. Most people will give up, but the few who are really determined, they'll start to investigate about the real reasons why they are in that hole, if that makes sense. And that's when the light bulbs start coming on, and I realize, oh my God, I just didn't have I had knowledge, but I didn't have the right knowledge, and that's how people can find their way out of that hole.
So your book actually goes a little bit further into the steps that traders can take to find or to get themselves out of that hole. Mm-hmm. So I guess I'd like to discuss a few of those principles with you today.
Oh, sure.
The first principle you call preparation. Can you explain what you mean by that a little bit?
Sure. We essentially, it's like a reality check of determining whether we are prepared to actually put the effort in to be successful. And, preparation, essentially, you got to ask yourself whether you are prepared to do the hard yards, because most of us come into trading because we always think it's greener on the other side of the fence. And like in most cases, it rarely is. So, I'm saying to people, just stop, close down the computer screen, don't try and work out where the markets are going. Just take a complete break from trading. And preparation is about understanding a couple of things, and then not only understanding these ideas, but accepting them. I suppose the first step in my preparation that I want other people to accept and prepare themselves is to accept a thing called maximum adversity. And what maximum adversity means is that you have to accept that the market's not going to make it easy. There's no free lunches. And what the market will do The market's going to do what it has to do to ensure that the majority lose. The market will do what it has to do in transferring money from the weak hands to the strong hands. And so it's like from the very, very beginning, please understand that if you're prepared to take another step down this training journey, that it's going to be all against you, and there's no shortcuts. It's just you're dealing against a being in the market that will be enthused in helping separate your risk capital from your trading account. In addition, I think once people accept that it's very hard to trade. It's actually simple to trade, but it's not easy. Like the actual process of trading, once you understand what to do, is reasonably simple. But the actual effort put into it is very hard. In addition, I think traders have to become what I call is emotionally orientated. When we come to trading, we've got everything back to front, because when we come to trading, we come to win. And our focus is being right. We have to win. We have to win. And not only do we want to win, we want to make a lot of money. And I refer to those two, experiences for somebody as that person is emotionally disorientated. Because once you know more about trading, you'll suddenly realize that our objective shouldn't be to win. Winning or a high accuracy rate is not that particularly important to be successful. And we shouldn't be hung up on trying to be right all the time. Where will the euro go? Where will the Dow Jones go? Where will the Nikkei go? Where will gold go? Where will oil go? We shouldn't be too worried about being right about that stuff. Instead, we should reorientate our emotional thoughts to not being right about trading, but in my opinion, our objective should be to manage our risk capital. That's the most important thing. Our objective should be to manage our risk capital, not to be right on the markets, not to win all of our trades. And in addition, I know we all come to make money, and I'm as guilty as the next person. But the fact is, if you remember Economics 101, the more money you want to earn, you have to accept more risk. You can't ignore that trade-off. Now, having said that, certainly over the last 5 years of this enormous central bank intervention and interference with the markets would suggest that if you want to make more money, you take on more risk, because guess what? There doesn't appear to be a lot of risk. I'm sure the historical relationship will be restored, which just essentially says if you want to make more money, you have to accept more risk. And so, sure, you can want to make more money, but understand you're going to be placing an enormous amount of risk on your trading capital, which means there's every likelihood that you will lose money, because risk is exactly what it is. It's dangerous. And so to become emotionally orientated, I think we should change our expectations from being right to basically managing our risk capital with a modest expectation. If you lower your expectations down to a reasonable level, you will find that you can make money consistently. There'll be times when you'll have a losing month and you have a losing year. But if you're consistent and you keep your risk manageable, you will earn a comfortable return over the longer term, year in, year out. In addition, people to become prepared for trading have to accept that trading is what I call a losing game, because 90 to 95% of your peers, people that actively trade, lose. So, when you think of trading, what you see in your head is laptops and blue oceans and beautiful beaches and palm trees, and just trading is it's for the winners and it's fantastic. It's a paradise. Well, it's not. It's full of people who are having a miserable experience. So once again, you have to accept this idea. Prepare yourself that if you wish to climb this mountain of trading, you have to accept it's essentially steep as. It's not easy. In addition, I think people have to accept that markets are essentially random. I know that in my early days of discretionary trading, a lot of my focus was on I wanted to be right about everything all the time. And for someone to be right about the future, it leads you down the path of actually becoming like a forecaster. And you're looking for those theories of technical analysis that hold out hope that with enough effort, you can actually work out where the market will go. And you essentially become top pickers and bottom pickers. And so I want people to understand that no one can predict where the markets are going consistently, accurately. And so best thing to do before you start trading is just accept the markets are essentially random. So please don't fall into the trap of becoming a forecaster, because it's essentially a path that's just littered with potholes and blind curves and disappointment. So people have to accept that it's essentially markets are at random. In addition, put a dollar limit on how much you're prepared to invest in trading. Whether it's $5,000, $10,000, $50,000, $100,000, $500,000, whatever it is that you want to put into this, define that as your limit. And if you lose it, walk away and give trading a complete break, or never come back to it ever again. And then communicate what that personal boundary is to somebody that you trust. Okay? You can't keep it internally, right? Because we tell ourselves these little white lies that, I was just unlucky. I'm going to be lucky. I'm going to be okay the next time I do this. No. You have to introduce transparency into what you're doing and tell someone who's preferably older than you, somebody that you respect, and somebody that you would not like to disappoint. Let them know what your financial boundaries are for trading, and communicate with them what you're doing, so that if things are very disappointing, that relationship you have with this older person may save yourself from yourself. In addition, I think there's only one secret to trading, despite all of the marketing that you see out there and all the suggestions that there are, secrets to success. I think to be fully prepared before you launch yourself into trading or relaunch yourself into trading is that you have to accept that the only real secret to trading is that the best loser is a long-term winner. The best loser is a long-term winner. The people who are still actively trading today are only actively trading today because they have enough risk capital to place that next trade. And to be able to have that amount of risk capital today is because they haven't lost all their money. Most people are bad losers. They move stops, or they don't use stops. They tell themselves little stories to encourage them to give their trades a little bit more room. And what eventually happens is that people do finally stop themselves out, but they stop themselves out at basically a catastrophic loss, because if they don't stop themselves out, they may have somebody knocking on their door and asking them for keys to their house. So I understand that that's probably the only real secret is you do lose often in trading, okay? And that's no big deal. As long as you take your losses, you've got to be a good loser. And essentially too, people think I'm a trader when they talk to me, and I'm interested in letting them know what I do. And I really tell people what I do to tell you the truth, because it's another thing I've learned in life is that don't try and tie up your self-esteem in the fact that you're a trader. It's not important to other people about what you do. What's important to you is that you manage your risk capital properly. Okay, you may be buying and selling, so technically you could be called a trader. But what you really have to think of yourself as is a risk manager. And that's how I perceive myself. I'm a risk manager. And all of my efforts, most of my efforts, is really focused on managing my risk, and ensuring that when I place my trades, I trade a lot of markets. I put a lot of effort into making sure that, I'm placing relatively small bets on all these markets I trade. I'm looking at my strategies, looking at equity momentums. I'm always managing the downside risk, because you know what? It's easy to bank a profit. Easy. Anyone can make a profit. It's how you handle the losses that is the challenge. So I know if people come into this thing as wanting to be traders, I understand that, But to be fully prepared to be successful in this game, you have to, once again, turn your mindset around and go, if you're going to be successful, the reason why you will be successful is probably the reason why I'm successful, and it's because I am more a risk manager than anything else. And then probably the final step that you'd need to do to be fully prepared is to find yourself a trading partner. It could be that mentor person I mentioned before, where you share with them what your financial boundary will be, like how much money are you prepared to invest or risk in this venture of trading. It could be that person, but regardless, you need somebody who does not live in your house, and you say to that person, I'd like to give trading a go, and I believe what will help me is if somebody can come along the journey with me, someone who is essentially going to keep me honest, because I will tell them what I'm doing and they will want to take an interest in what I'm doing. And I hope they keep reminding me about my financial boundary so I don't keep throwing in good money after bad money. And in addition, that trading partner will become very important, that when you decide that you have developed a good strategy, I believe that before you start risking real money in real markets on your strategy, then you should do something that I call the test, which is 30 emailed simulated trades, where you will actually use your trading partner as like a virtual broker, where you'll tell your broker that, okay, I'm going to start trading my strategy, and I'd like to give my orders to you, and I want you to report back to me about how I go as I enter the market, and as I manage my positions, and as I take profits or get stopped out. And it's similar to what a lot of people may hear about in regards to paper trading. Well, I don't. I can understand that the merits of paper trading are very good. I just don't agree with how that's executed. I think it's better to use an external trading partner to help you see whether your strategy will actually be profitable without you trading real money. So there are probably 5 or 6 points that I think are really important that people have to accept to essentially put them in a prepared position that says, you know what, I think I'm prepared to embark on this bumpy and challenging, although rewarding journey. And that is, accept it's going to be all against you with maximum adversity. Understand that don't come to the markets thinking that you have to be right all the time. No, your objective shouldn't be to be right. Your objective should be to manage your risk capital with a modest expectation. So also, don't come into trading thinking you're going to be a millionaire in 6 months' time. Change your expectations to a modest level where you can earn 20 to 30, sometimes 40% return on your risk capital per annum. Get yourself emotionally orientated. Understand that you're entering a career which is littered by failure. It's a loser's game. There's very few winners. Accept that markets are random. You're not going to have a crystal ball to make easy trades. Set that financial boundary, how much money you're going to limit in terms of this trading experience. Understand the only real secret to trading is being the best loser. If you can be the best loser, you will be a long-term winner. And understand, although you come to this thing to become a trader, as you dig deeper into what you do, you'll realize that what will make you successful is the fact that you will have become a good risk manager. And please find somebody that you respect and bring them along with you as you embark on this trading journey. And I think if people can accept these key points, that would be a very positive step. And that's essentially the first step in what I believe are the universal principles of successful trading, which is get yourself prepared.
That was so much amazing information and advice there. Thank you very much for sharing that. Especially the idea of being a risk manager and best loser wins. That ties in nicely with a statement you make about avoiding risk of ruin. Can you explain what risk of ruin is?
Sure. In my humble opinion, I think risk of ruin is number one or the most important concept in trading. I can tell you that everybody who has traded and lost would have, or did have, if they don't trade anymore, would have a risk of ruin above 0%. Because risk of ruin is just a pretty simple concept. It's a mathematical measure that will tell a trader that based on how much money they wish to allocate per trade, according to the way they wish to trade the market, that will produce a mathematical percentage or likelihood or probability that if they continue to trade according to what percentage of their risk capital they want to place in the trade, according to their methodology, where they want to enter a market, place a stop and exit, and when you combine those two, mathematically they produce a probability, if the trader continues that way, that what their probability will be that they'll reach a point in their account balance that says they can no longer trade. That is, they've reached their ruin point. So it's risk of ruin. What is the probability that the way you want to trade will result in you essentially blowing up your account? And to me, it's the number one concept. And this is why, I believe that why people lose is essentially most people are clueless about this key concept about risk of ruin. If that's the only idea that people pick out of my book, and I talk about this a lot when I do presentations, then certainly the time I took and the effort I took into writing this book, and the time I'd take to travel and talk to people would certainly be worth it, because people aren't stupid. People aren't stupid, and once you tell people that, guess what? The way that you determine how much you're prepared to risk on a trade, once you marry that with the way that you want to trade the markets, it has to produce a mathematical probability about whether you will be essentially successful or broke, which is risk of ruin. That is a huge light bulb moment for most people, because they can go back and go, oh my God, calculations, God, my risk of ruin is 30%, 20%, 10%. It's far too high. I have to stop trading. And understanding risk of ruin actually gives you a line in the sand that says that you should not be trading if your mathematical risk of ruin is essentially above 0%. Because even with somebody who has a very low risk of ruin of, say, 2, 3, 1%, that may be a lot better, or certainly is a lot better than somebody who has a risk of ruin of 30, 40, or 50%. But the fact is, regardless of how big that number is, any number above 0% is still a guarantee that that person will eventually go bust. It's just a matter of time. So it's a really key concept. And I talk to people I talk about this universal truth about trading. And it's the universal truth, I suppose, sits above the universal principles of successful trading. And essentially, there's only really three key points people need to understand on the first level, I suppose, about trading. That trading successfully, is dependent on these three ideas, and it's what I call the universal truths, and that is successful trading is based on three simple ideas. And number one is knowing the math, and the important thing behind the math is ensure you're trading with a 0% risk of ruin. So that's number one. This is the first element of my universal truth, that successful trading is essentially based on understanding the math, which is your 0% risk of ruin. Number two, being the best loser. And number three is being able to endure the pain and disappointment of losing. They're like the three tips of icebergs. You understand those three and you delve down, and you're going to go a long way to being successful in this business. So risk of ruin is number one. Most important concept of trading. I can't stress it enough, because once you get your idea behind this idea that when you combine how much you risk on a trade with the way you trade, that produces a mathematical calculation of what's called risk of ruin. And once you know that you should not be trading with a risk of ruin above 0%, for most people, they'll be hands down and they'll stop trading. And that's going to be a positive outcome for those people, because no doubt they're just losing all the time. And then they can actually work backwards and say, okay, really for me to become profitable, I need to get my risk of ruin down from 17%, or down from 8%, or down from 25%, down to 0%. And that's when they start to become knowledgeable, because now they're working out what's important. And that leads to really key concepts like money management, another key concept called expectancy, and they're on their way. So to me, it's just the number one foundation stone of profitable trading.
Well, that sounds like it's definitely a beneficial exercise if we all go through and calculate the risk of ruin.
That's right.
For ourselves. You just mentioned expectancy. Mm-hmm. Before we go to that, in your book, you talk about trading's holy grail. So we often hear the holy grail of trading. Mm-hmm. Some people claim to have found it. Yeah. Others claim it doesn't actually exist. Yeah. What do you think the holy grail of trading is?
Sure. You're right. The holy grail is that cliche that we all would wish was had substance and had truth, and if we could all just sip from that holy grail, life would be a lot easier. I've been a bit cheeky in the terms I've actually used that cliche, but I've done it to try and underline the importance of this idea I want to share with people. Now, you're right, Andrew. Historically, traders are looking for the holy grail, which is a trading methodology that would maximize the profits while minimizing the pain. In a nutshell, people are looking for that magic indicator, that perfect entry technique, whatever it is that just gives us profit, and very little losses. Now, like you, I've never found one, and hand on my heart, I've been doing this trading for over 30 years. I haven't found one. However, my holy grail is this idea that the way we make money is a simple formula called Holy Grail equals O times E. O refers to opportunities. E refers to expectancy. Okay. Opportunities just refers to setups in the market. How many setups can we see in the markets that can allow us to take an opportunity trades in the market? And we marry that with E, which is expectancy. And expectancy comes from our methodology. Where do we buy or sell? Where do we place our stops? And how do we exit? And so you need to marry a strategy or a methodology which has a positive expectancy, with markets that can give us plenty of opportunities to trade. Now, as an example, if I had a methodology that only produced one trade a year, and even if that trade was just like it's got 100% expectancy, 100% accuracy. Now, if I talked about a strategy that I had and I wanted to share with people, and I could say historically it's never had a losing trade, that would excite a lot of people because it could possibly be a holy grail because it's never had a losing trade. It's got 100% expectancy. Now, on one level you go, hey, that's fantastic. But then when you ask the question, well, how often does this strategy trade? And the answer is, just once a year. Then you think, well, that's not going to really help me pay my bills, pay the mortgage, send my kids to school, buy the cars, pay for insurance. Because only one trade a year is just not enough. And that's why my holy grail is, yes, we need a good methodology. A methodology of where we enter, place our stops and our exits will give us an expectancy of how much money we can earn on average for every dollar that we lose in a methodology. That has to be applied across more than one opportunity. I know that my example of using one opportunity per year is a bit extreme, but this is what I'm trying to demonstrate, that the holy grail is have a good strategy that gives you a positive expectancy, but have one that's going to allow you to trade regularly, because you need opportunities to risk your money to potentially make profits. And so the more opportunities you have when you combine your good methodology will allow you to make more money. So that's my holy grail. My holy grail is, you gotta find that good balance between a strategy that gives you an expectation to make money over longer term, but also is a strategy that can find you a lot of opportunities to trade. So that's my holy grail.
Thanks a lot for sharing that, Brent. If I can jump now to principle number 5, which is the 3 pillars of trading. At a high level, can you explain what the 3 pillars are?
Sure. The 3 pillars of trading essentially money management, methodology, and psychology. So once you've got yourself prepared and you're working through all these issues, and this is before you're trading, that you've got these 3 key pillars that's going to hold up, yourself, and hopefully your trading account as you trade profitably. So it's money management, methodology, and psychology. And we've touched upon money management a bit and methodology. Money management, in my opinion, is the most important pillar out of the whole 3. A lot of people disagree with me, and that a lot of people believe that psychology is probably the number 1 pillar out of the 3. I think money management's ranked higher, but this is just semantics. At the end of the day, all 3 work together. All 3 are important. Now, money management is a key weapon against risk of ruin. Money management tells us how much money we should be prepared to risk on any individual trade. And it's good money management that's going to have the most powerful impact and be the greatest value driver in getting your risk of ruin down to 0%. And this is why understanding risk of ruin is so important, because that's the tip of the iceberg. Once you go into the internals of risk of ruin and you look at those key weapons against risk of ruin, you'll see money management is the number 1 cog there that's going to have the biggest impact on keeping your risk of ruin down to 0%. So that's why I say money management is number 1. And there's just 2 key points to money management. And that is, as we are losing money trading, we should risk less. And on the other side, as we are making money, be brave and risk more money. So money management is not only a key weapon against risk of ruin, which means it's a key reason why we survive in trading. It's also a key reason behind why you can make a lot of money in trading. Because once you apply money management to a good strategy, it will transform that strategy to being a money-making machine. So number 1 is money management. In my opinion, number 2 is methodology. And methodology will describe how we go about our business of looking for setups in the marketplace, where we look for places to look for support, look for resistance, or look for the trend, or look for counter-trend trades. It will tell us where we should be executing in the market to support higher prices, or where we should be selling in the market to expect lower prices. Our methodology will tell us once we're in a trade where should be a sensible place to put our protection in, our stop. And our methodology will also tell us how we take our profits. Now, the methodology, once you bundle it all up and you put it into a box, okay, the top of that box's lid will have a really key concept written on it, and it's called expectancy. So once you've worked out how you want to trade and you stick it in that box and you bundle it up and you put a lid on that box, guess what? That box, your methodology, will tell you what you can expect to earn if you trade according to the methodology in your box for every dollar on average that you lose in a trade. And so when you trade with your methodology, you want to trade with a positive expectancy. And so we're not saying that we have to win every trade, but we do expect that over a period of time, that if our methodology is any good, we should expect to see a stable equity curve, and we should expect to therefore earn a positive expectancy. And so once again, if we go back to our risk of ruin concept, we know that risk of ruin, to get 0%, we have to have good, sensible money management combined with a methodology that produces a positive expectancy. So percentage money management with a percentage expectancy, when you multiply those together, it gives you a percentage risk of ruin. So once again, understanding what risk of ruin is gets you into these important concepts. And so methodology, sure, on one level, it tells you how to trade, but more importantly, it tells you why you're trading, and that is for a positive expectancy. Now, the third pillar, which I think is slightly less important for the first two, is about psychology. And psychology is essentially the glue that brings everything together. And this is our mindset. It's one thing to know the theory, the good theory, which is about sensible money management, about a good methodology with positive expectancy. It's another thing to actually execute the theory into the market where there are day-to-day distractions, all sorts of stuff going on that can interrupt a well-planned strategy for successful trading. And within psychology, we've essentially got three key elements, maybe a fourth. The three key elements we have to understand with psychology to ensure that we can have the proper mindset when we trade regards three key concepts, which is essentially hope, greed, and fear. And you find that hope, greed, and fear can be speed bumps or booby traps that can interrupt your good intentions in executing your plan according to your money management strategy and according to your methodology. Let's look at hope. Hope refers to those moments in time when you go to bed and you start to pray and you're hoping that your next trade will be a winner. So when you find that you're crossing your heart or crossing your fingers about a particular trade, then essentially you're hoping. And the reason why most people hope is because they know that if they take another loss, that's just going to really damage their account and they'll probably stop trading. And the reason why most people hope is because they have no idea about their risk of ruin. They've got no idea about expectancy. So a simple way to get rid of hope is to essentially learn about risk of ruin, get into the mathematics of risk of ruin, and measure your own risk of ruin. And if it's not 0%, then do something about it to get to 0%. And that will also require you to introduce positive expectancy into your trading. Once you manage to do that, you'll stop hoping and you'll be trading with a modest expectation, and you'll be trading with a positive expectancy. So you want to get rid of hope. You want to make sure hope doesn't trip you up in your good intentions to trade according to your plan. Then you have this thing called greed. Everyone suffers from it, and in trading in particular, the reason why we suffer from greed is because we're not satisfied with what we have. We want more. And in trading, if you want to make more money, our natural default position is that we trade more often. We think more trading, more money. And once again, that becomes a self-defeating spiral where you just dig yourself into a deeper and deeper hole because you're losing more money. And you think if you just trade some more aggressively and you double up, you'll make back all your losses. So before you know it, blowing up your account. The best way to combat greed is to fix up your orientation, shift your emotional orientation from wanting to be right, from wanting to make a lot of money, to change your expectation to my objective in trading is not to be right or wrong, but it's to manage my risk capital with a modest expectation. That's the key. Modest expectations. Think of yourself in 12 months' time. Think of how good you feel about yourself. If you could then look over your shoulder over the previous 12 months and see how you've earned a 20 or a 25 or a 30% return on your risk capital. And just imagine how good you would feel about yourself if you could achieve that type of return. And once you feel good about that, remember how good that feels and think to yourself, that's enough. Because you have to understand, Economics 101, the more risk you take on, the more money you want to make, the more risk you have to accept, which means it's dangerous. So please, to ensure that greed does not trip you up, become happy with what you have, and you do that by having becoming emotionally orientated and having modest expectations. And the third main element of psychology is fear. We don't want fear to interrupt what we're doing. And fear is an important one because we can all be fearful about tomorrow and the future, and no one likes to lose money. The only way I've worked out how to combat fear, because if anyone should be fearful about the markets, it should be me, because I've got a trade going everywhere. I don't think I've ever had a day without a position somewhere long or short in the market. And the best way to overcome fear, well, I suppose the biggest concern fear has, in my opinion, is that it manifests itself in the uncertainty of tomorrow. I don't know what's going to happen tomorrow. I don't know what the Dow Jones will do tomorrow. I don't know what gold's going to do tomorrow. I don't know what soya beans are going to do tomorrow. I've got no idea whether the euro dollar will still be a currency tomorrow. That's fearful. If that's fearful, I'm not going to trade. And yet, we understand with my holy grail is opportunities times expectancy. Now, it's no good if I've got a very good positive expectancy methodology if I can't apply it to the markets against opportunities. And I won't apply it against opportunities if I'm fearful about tomorrow, if I'm fearful about the markets. I won't be trading. I won't be taking advantage of these opportunities. So it's important that we learn how to combat or remove our fear. And what I do personally is that I combat my fear by taking it head on, and I basically embrace it and I squeeze it into nothing. And the way I do it is, well, what's my fear? Well, I suppose my fear is losing money. So what I do, and what I encourage other people to do, is that before you place your trade, when you have a setup for whatever particular markets you trade, and you know how much money you're prepared to lose, debit that potential loss against your profit and loss spreadsheet before you place that trade. Okay? So debit it before you place that trade, and have a look at your account balance. And you know, that account balance right now is essentially the worst the market's going to do to you. And you look at that, and if you can live with that, you should have no fear about placing the trade, because you've taken away the sting from the market, taken away from the market that power it has over you, because you're fearful from taking another punch from the market. You know what? Well, just take the punch before you go into the ring, and then you just remove the fear of the markets, because what more can the markets do to you that you haven't already done to yourself? Because you have debited your spreadsheet with your expected loss. Okay, and if you can learn to do that, I believe, well, certainly for me, it just removes the fear of trading, because I know I trade relatively small to my account balance. It's just an irritation, these individual losses that I have. It's not going to kill me. I can still trade the next day, the next month, and the next year, and I've got no fear. So that is like the third main element of psychology. Now, I have a fourth element of psychology that I think is also worth people focusing on and being aware of before you come into this thing called trading, and that is you need to learn to endure pain. Now, it's just not pain of you losing, right? It's pain on so many different levels. You don't learn about these things until you've actually been doing it for years. But pain from trading can come from, it's almost like a virtual 360, degree, attack on what you're doing. Briefly, for example, we know there's a pain of losing. Well, we can handle that because we debit our loss before we place our trade, so that's no big deal. But there's pain on other levels, like the pain, say very simply buying a trading book because you believe that that book has some answers, and you read it and you think that's reasonable, and then you go to the pain of putting the effort into validating the ideas, and after a while, after putting your efforts in, you come to the conclusion that there's no value in the idea. It's got a negative expectancy. Straight away, there's pain and disappointment. There's pain, a pain of drawdowns, which is just the accumulation of multiple little trades. Hopefully, a long drawdown will never wipe you out, but although it does wipe out most people. But there's pain of enduring drawdowns over a period of 3, 6, 9, 12 months. That's enormous pain. It's so important to me that I think that in terms of psychology, a lot of books have been written about hope, greed, and fear. And I think it's important that we should also talk about this idea of pain. And people have to learn to endure pain on multiple levels and find out what those individual pains are so you can prepare yourself for disappointment. And that sort of rounds off the psychology, which rounds off those three pillars of money management, methodology, and psychology.
Thanks a lot for that, Brent. Especially like the tip on how to manage fear by accepting the loss when you put the trade on. That's it's a great tip that we can all implement straight away. So thanks for sharing that. If I can just ask one more question, just going back to money management. There's a concept in your book that I haven't actually seen anywhere else. I think you may have introduced it in your Trading the Spy book. It's a concept of trading equity momentum. Can you explain a little bit about what that is, how it works?
Sure. It's a key concept that I personally hate, but it's a very important one. Equity momentum refers to monitoring our strategy as we trade it to see how it's performing. After we've done all the hard work, done all the investigation, done all the test, and we decide to put real money behind our methodology, it is our strongest preference that the historical equity curve that we've seen in the past will continue into the future. That is, we have a very, very strong preference that the way we trade will have what I call a stable equity curve, an equity curve that's upward sloping. Now, unfortunately, not everything that we do will continue to have an upward sloping equity curve. It'll start dipping down either because, one, strategies have drawdowns, that's for sure, or it could be dipping down because it's lost its edge. And whereas before the previous 20, 30, 40 years, 15 years, it's been going up, it could be at the start of a permanent decline where the equity curve just goes down and down and down and has a little blip rally for a moment and goes down again, and a little bit of a blip rally up and think, oh, good's coming back, but then it just keeps going down. So just like in trading, with individual trading, an individual trade, we use stops to protect ourselves in the market. I believe we also need to use essentially a system stop. And so trading equity momentum is essentially we as traders saying, okay, what tool, what measurement should we use to tell us that our strategy's equity curve has come to a position where its stability is in question. And if it's in question, maybe we should step to the sidelines, keep measuring our strategy, keep monitoring our strategy, but not take the signals because we're not sure what's happening. We hope it's just going to be a temporary drawdown. However, we should expect the worst in trading. Remember the key concept of maximum adversity. We have to expect the worst when we're trading and be prepared for the worst, which is maybe the strategy that I've been trading for 10 years, maybe it's just lost its edge and its equity curve will now be declining. So we need to give the way that we trade essentially an overall system stop that says, hey, hands up, something strange is happening. Let's not risk any more money on our strategy until the equity curve pops back up and shows a positive upward trend. And in the meantime, hopefully we're trading a portfolio of strategies. So we'll still be trading. We just won't be trading that particular strategy. So trading equity momentum is all about ensuring that we continue to monitor, even though we're trading it. We want to monitor the equity curve of that particular strategy that we trade. And we need to use tools that can actually give us a pretty good heads up that this is the time to stop taking the signals of that strategy. And just as importantly, we need to be able to know when the equity curve has actually popped back up and it's then safe to recommence trading the signals. Now, just like in trading, there is no perfect individual stop for individual strategies. Unfortunately, there is no perfect strategy stop or system stop that can help us identify or measure equity momentum. Now, as an example of what I'm talking about, people may like to use a simple 50 trade or 100 trade moving average of their equity curve. And if their equity curve dips below the moving average, then that would suggest to them they should not follow the signals until the equity curve can pop back up above the moving average of the equity curve. And when the equity curve is popped back up above the moving average of the equity curve, that's when they can recommence trading the signals. That's just a simple method somebody could use for measuring their equity momentum. Now, the reason why I hate equity momentum is because if you have a good strategy, there's nothing worse than switching off the signals or stop trading the signals just before it finds its feet again and its equity curve starts to trade upwards. Because just when it's recovering from its drawdown, that's when you'll move to the sidelines. So it is. I'm telling you now, it's very frustrating trading with trading equity momentum. Now, this is a very important point. Even though it's aggravating, even though it's it's painful, it's disappointing. Think of any expletive. Trading equity curve is all of those. However, and the reason why that trading equity momentum is aggravating is because when you run a system kill switch on your strategy, you will actually see that it actually cuts down your profits. You'll go, why am I doing this? It's just actually, it's reduced my profitability. And that's why it's aggravating, because if you have a good strategy and you don't trade the signals when there's negative equity momentum, it's aggravating because you will miss those good trades for when the equity curve pops up. However, you have to keep reminding yourself that trading equity momentum is not designed to maximize your profits. Trading equity momentum is all designed about preserving your capital. And that's the most important thing, is preserving your capital. We have to, as risk managers / traders, we have to always have enough money left, to place that next trade. Okay? And that's why I think it's so important to trade equity momentums, because we don't know what's going to happen tomorrow. We don't know about the future. And we do respect this key concept about maximum adversity. The market will do what it has to do to disappoint the majority of traders, which include you and I, right? That there will come a time when a good strategy will, I suppose, eventually stop working. And we should be prepared to try and measure when that happens, identify it, and move to the sidelines. Even when there's a risk, a short-term dip in profitability risk, that the equity curve will quickly recover and pop back up. Because for those times, most multiple times, when you disadvantage yourself by stepping to the sidelines too early, I can tell you that will all be made up for that one time when you've done the right thing before one of your strategy's equity curve just falls off a cliff, and you've been saved from trading all those signals all the way down. So that's my idea of trading equity momentum. It's a simple idea that just like when we trade, we have individual stops. I believe that when we trade a strategy, even though it can be frustrating, it does reduce your profitability. I think it's very important to trade a system stop, because its number one objective is to preserve your capital.
Excellent. Thanks a lot, Brent. I strongly suggest everyone explore the idea of equity momentum. I've actually used it myself, and it's saved me some money. So thank you for introducing that concept, Brent.
No worries.
If we can just finish up now with a couple of closing questions.
Mm-hmm.
The first one, what's the biggest lesson you've learned through trading?
Money management. I blew up twice and almost a third time. And this is before I understood this concept of risk of ruin. And sure, my strategies at the time may not have been as good as what they are today, but what blew my accounts up was simply I was risking too much money per trade. My risk of ruin would have been like 40 or 45%, maybe above 50%. And if I'd known about this key concept of risk of ruin 20, 25 years ago, I would have avoided all that pain I went through. Number one, risk of ruin. risk of ruin, which money management is a key weapon against risk of ruin. So money management was that first manifestation that says I'm risking too much money, and that led to this understanding, hey, risk of ruin. My risk of ruin was too high. No wonder I lost. I have to get my money management under control and introduce positive expectancy. So money management that led to risk of ruin.
Thanks. What's the best piece of trading advice you ever received?
Money management.
I'm sensing a theme here.
Money management, because it's a key weapon against risk of ruin.
Right. What's your favourite trading book?
Oh, trading. Probably Reminiscences of a Stock Operator.
It's a classic.
Classic. And I can just remember my treasurer at Bank America. I think I'd been going through a pretty rubbish period trading bank bills. And my treasurer just gave it to me to read it. And I read it over, I think, one Saturday afternoon. And I can just remember, I'll be flicking the pages and it talk about, Jesse Livermore and how he came to this realization that what he was doing was wrong. And I was thinking to myself, that's me. I was reading about myself, but without making all the big profits. And, that was just, it's a wonderful book. And, it always stuck with me. I got about 4 copies on my bookshelf. Yeah.
And finally, what's the best way for listeners to get in touch with you?
Oh, probably just through the website, just to really actually, I encourage people come to the website and they get excited, and I just tell them, they read my book, and believe it or not, most haven't, and I just ask them to get a copy of the book, the universal principles of successful trading. For people to have the best chance to use my strategies, they've got to understand where I come from. And so I encourage people, read the book. It's only $50 or $40. Now, I don't say that because I make any money out of the book. I think my royalty, I think I get like $2.50 per book. So believe me, I'm not getting rich on selling this book. But I think if people read the book and some of the ideas, if not all of the ideas resonate with them, then certainly the book's got my website address in it. From the book they can find the website, and from the website they can find me. And they're happy to talk to people. No worries. But best read this book, and and I really liked your first question that you asked me today was about the preparation. And this book is all about are you prepared to embark upon this path that, even though it's the destination is very rewarding, it's a path or a journey that's just full of crocodiles, and it's best to have your eyes wide open, if I can use that expression. And I hope my book gives people the heads up that although it's rewarding if you can complete your journey, but you need to understand it's not an effortless journey. It takes effort. So I'd encourage people to read the book, and if they like what they read, then certainly through the book and through the website, they can find out how they can make contact with me.
Okay, excellent. So thanks so much for sharing your knowledge and experience with us today, Brent.
No worries, Andrew, and many thanks for having me on.
All right, thanks. Appreciate your time.
Okay.
Bye-bye.
Yeah, bye.
What an interview. What did you take away from the knowledge Brent shared with us? Here are my top 5 tips or insights from the episode today. So managing risk was a consistent theme. Brent said our objective should be to manage our risk capital, not to be right in the markets. So I guess it's human nature to want to be right, but we shouldn't let that get in the way of the real objective, which is to manage our risk capital. The second tip, the most important thing is preserving your capital. Brent definitely made that point clear today, didn't he? The risk of ruin concept was enlightening. I mean, you absolutely must know your risk of ruin figure, and it has to be 0 or 0%. Otherwise, you're guaranteed to go bust eventually. It's just a matter of time. I really enjoyed the concept of equity momentum and how it can save you from a broken strategy. Market conditions change, strategies stop working. What checks do you have in place to identify if a strategy is performing poorly or possibly broken? Brent showed us a simple method to save us from a broken strategy. And I guess the final point was how to overcome fear by tackling it head on. It was a great tip that Brent shared that by debiting your potential loss from your account balance before you place a trade, you have a better chance of accepting that loss. In the next episode, we have a guest who spent 9 years as a professional market researcher for Connors Research and TradingMarkets.com. He's been at the forefront of stock market research, having developed a number of successful trading systems now used by numerous investors and fund managers in the United States and internationally. In our chat, we discussed trading ideas, key concepts and pitfalls of backtesting, the impact of stops on returns, also drawdown, market timing and using multiple strategies in a portfolio. It's a great interview, so go check that one out. Also, don't forget to check out the show notes page for this episode where we have more details from the interview, including links to websites, books, quotes, an interview transcript and some bonus content. The bonus content for this episode is a detailed article on risk of ruin along with a free risk of ruin calculator that Brent has kindly provided us for download so you can confirm the risk of ruin for your own trading results. You may be surprised what it tells you. The show notes for this episode can be accessed directly by typing the episode number after bettersystemtrader.com. So to access this episode, which is episode 2, just type bettersystemtrader.com/2 into your browser and you'll jump straight to it. So I hope you enjoyed today's episode. Thanks for listening to Better System Trader, and please let me know what you think in the comment section. Oh, and of course, if you love it, share it with your friends. Catch you next time. Thanks for listening.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.